The Federal Reserve is trapped. Not struggling, not challenged, trapped. If they cut interest rates to save the banking system, inflation explodes. If they keep rates elevated to fight inflation, the commercial real estate market implodes and takes regional banks with it. There's no third door. There's no soft landing. And the people who run the global financial system know it. This isn't speculation. This is arithmetic. The United States government is now adding $1 trillion to its national debt every 100 days. Interest payments on that debt have surpassed what America spends on its entire military. When a nation reaches that threshold, economists have a clinical term for it, a debt trap. And history tells us there's only one way out of a debt trap. You devalue the currency until the debt becomes manageable, which means every dollar sitting in your savings account is slowly being sacrificed to pay for decisions made decades ago. But here's what makes this moment different from every financial crisis that came before it. The institutions that created this problem are quietly preparing for its conclusion. While financial news networks debate interest rate projections and soft landing scenarios, central banks around the world are engaged in the largest physical gold accumulation in modern history. In 2023 alone, they purchased over 1,000 metric tons. Not paper contracts, not ETF shares. Physical bars moved into sovereign vaults beyond the reach of any digital ledger or banking counterparty. The World Economic Forum, the same organization that spent 3 decades championing borderless trade and financial integration, recently acknowledged what many considered unthinkable. The era of hyper-globalization has hit a structural wall. Not a temporary setback, a wall. And when the architects of a system begin admitting its failure, the question isn't whether change is coming. It's whether you're positioned for what replaces it. The thesis is straightforward. We are witnessing the largest transfer of wealth in modern history, moving from paper promises to physical reality. From digital ledgers controlled by institutions to tangible assets that exist independent of any banking system. The data supporting this isn't hidden. It's published quarterly in central bank reports, buried in FDIC filings, and visible in the premium prices people are paying just to take physical delivery of precious metals. The pattern is unmistakable if you know where to look. To understand why this is happening now and why the next 5 years will reshape wealth in ways most people aren't prepared for, we need to examine how we built a global economy on a foundation that was never designed to hold this much weight. 50 years ago, American factories employed a quarter of the nation's workforce and contributed 25% of GDP. Manufacturing wasn't just an industry, it was the spine of middle-class prosperity. Today, that figure has collapsed to less than 11%. But the decline wasn't accidental, and it wasn't inevitable. It was a deliberate corporate strategy, executed over decades in pursuit of lower labor costs and higher profit margins. The logic seemed elegant at the time. American consumers would benefit from cheaper goods. Corporations would benefit from reduced production costs. And developing nations would benefit from industrial jobs. Everyone wins. Except the math never accounted for what happens when a nation outsources its capacity to produce essential goods, when the factories that once made semiconductors, pharmaceuticals, and industrial components are dismantled and rebuilt on the other side of the world. The fragility of this arrangement became impossible to ignore in 2020. When global supply chains seized, the United States discovered it could no longer manufacture its own essential medicines. It couldn't produce the chips required for its automotive industry, a shortage that cost the sector $200 billion in a single year. The efficiency gains of globalization had created a dependency so complete that a single disruption could paralyze entire sectors of the economy. The response has been a frantic attempt to reverse course. Reshoring, the process of bringing manufacturing back to American soil, is now federal policy. But rebuilding industrial capacity that took 50 years to dismantle doesn't happen overnight. Current estimates suggest over $1 trillion in infrastructure and automation investment will be required over the next 5 years, just to restore basic production capabilities. And every dollar of that investment is inflationary, because you cannot pay American workers without American wages. This is the hidden cost of deglobalization. For 3 decades, the United States effectively exported its inflation by purchasing cheap goods manufactured abroad. That arrangement masked the true decline in the dollar's purchasing power. Now, as trade barriers rise and geopolitical tensions fragment the global marketplace into competing economic blocs, that inflation is returning home. If you are starting to see why this matters for your own financial planning, if the pattern is becoming clear, take a moment to subscribe and hit the like button. Because what we're about to examine is where this structural shift becomes personal, and it involves something most financial advisors won't discuss openly. The fractures in the banking system aren't theoretical. They're quantified. As of late 2023, American banks were sitting on over $680 billion in unrealized losses. These are not projected losses or stress test scenarios. These are actual losses on long-term treasury bonds that banks purchased when interest rates were near zero, now worth dramatically less in a higher rate environment. The FDIC published these numbers. They're in the quarterly reports, and they represent a vulnerability that most depositors don't fully appreciate. The American banking system operates on fractional reserves, a model where banks hold only a small percentage of deposits in actual liquid assets, letting the rest to generate returns. This works seamlessly when confidence remains intact. But the mathematics become precarious under stress. Industry analysts estimate that if even 5% of depositors simultaneously requested their funds in cash, the system would freeze. Not fail, freeze. The money simply isn't there in physical form. 3 of the largest bank failures in American history occurred in 2023. The official narrative framed these as isolated incidents, mismanagement by specific institutions. But the underlying cause was structural, a mismatch between long-duration assets and short-term liabilities in a rising rate environment. Every regional bank in America faces some version of this exposure. The question isn't whether more institutions are vulnerable, it's which ones and when. Meanwhile, a parallel financial system is emerging in the shadows. While retail investors are encouraged to hold digital assets and speculative equities, a different class of wealth is moving in the opposite direction. Ultra-high net worth individuals and institutional investors are quietly accumulating physical commodities at a pace not seen since the stagflation era of the 1970s. Productive farmland, physical bullion, assets that exist outside the banking ledger. The commercial real estate market adds another dimension to this fragility. Nearly $1.5 trillion in commercial mortgage debt comes due by the end of 2025. Office buildings that once anchored bank balance sheets are now worth half their appraised value, casualties of the remote work revolution. Regional banks, the same institutions that provide the majority of small business loans in America, are directly exposed to this collapse. The conventional portfolio, 60% stocks, 40% bonds, was designed for a world of stable interest rates and expanding global trade. That world no longer exists. The correlation between asset classes that once provided diversification has broken down. Bonds no longer reliably offset equity losses when the central bank is trapped between inflation and insolvency. What remains are the assets that have survived every monetary system, every empire, every economic restructuring in recorded history. And understanding why requires examining what central banks themselves are doing, not what they're saying. The People's Bank of China added gold to its reserves for 14 consecutive months through 2023. Not paper claims. Physical metal. India, Russia, Turkey, and a dozen other nations followed similar patterns. This coordinated accumulation is not coincidental, is preparation for a monetary system that looks fundamentally different from the one that's governed global trade since 1971. When the United States severed the dollar's link to gold over 50 years ago, it created a monetary experiment unprecedented in human history, a global reserve currency backed by nothing but confidence in American institutions. That experiment has required increasingly aggressive interventions to sustain. The Federal Reserve's balance sheet, which sat below $1 trillion before 2008, peaked at nearly $9 trillion in 2022. This explosion of liquidity was the fuel that kept the globalization engine running, and it created asset bubbles whose deflation we're only beginning to experience. Here's the calculation that keeps central bankers awake at night. The total value of all gold ever mined is approximately $14 trillion. Global debt now exceeds $300 trillion. If the world moved toward any form of commodity-backed monetary standard, even a partial one, the price of gold would need to be revalued into the tens of thousands of dollars per ounce, simply to cover existing currency in circulation. This isn't fantasy, it's arithmetic. And it explains why institutions are accumulating while publicly downplaying the significance of hard assets. Silver presents an even more asymmetric situation. Unlike gold, which is primarily stored as a monetary reserve, silver is consumed industrially. Every solar panel, every electric vehicle, every advanced semiconductor requires silver's unique conductive properties. Industrial demand is projected to exceed 1.2 billion ounces in 2024, while mining production has remained essentially flat for a decade. We're currently operating in a multi-year supply deficit, consuming more silver than we extract from the ground. This creates a situation without parallel in precious metals history. The price of silver remains suppressed, trading at a fraction of its inflation-adjusted highs. Yet the physical metal is becoming increasingly scarce. Delivery premiums, the amount buyers pay above the quoted spot price to receive actual metal, have climbed to 10, sometimes 20%. The gap between paper markets, where trillions in contracts trade daily, and physical reality, where the actual metal must be delivered, is widening. So here's the question worth considering. If central banks are accumulating gold while telling the public to invest in digital assets and growth stocks, whose interests are being served? And if institutional wealth is rotating out of paper claims and into physical reality, what does that suggest about the stability of the system they're quietly exiting? Drop your perspective in the comments. I'm genuinely interested in how you're interpreting these patterns. The implications of this divergence don't remain abstract. They become personal. Since 1980, the purchasing power of the dollar has declined by more than 75%. A house that cost $50,000 in 1970 now costs $450,000. But here's what rarely gets discussed. When you price that same house in gold ounces rather than dollars, the cost has remained remarkably stable across 5 decades. The house didn't become more valuable. The currency used to measure it became less valuable. This is the lens through which generational wealth has always been preserved, not through paper instruments whose value depends on institutional promises, but through tangible assets whose worth exists independent of any banking system or government policy. The families who understood this during the stagflation of the 1970s, when gold moved from $35 to $800, when silver moved from under $2 to $50, didn't just survive that decade. They emerged wealthier in real terms while those holding cash and bonds watched their savings evaporate. We are entering a period of economic nationalism where control over physical resources, lithium, copper, silver, energy, will determine which nations and which individuals thrive. The United States holds the world's largest official gold reserves at over 8,000 tons. But that metal sits in deep storage, inaccessible to the average citizen whose retirement savings exist as digits on a brokerage statement. The question facing every household is straightforward. Do you hold assets that require institutional permission to access, or assets that exist independently of any counterparty? During the banking tremors of 2023, depositors at failing institutions discovered that their funds weren't immediately accessible. Accounts were frozen. Withdrawals were limited. The promise of liquidity that defines modern banking revealed its conditional nature. What you can do is evaluate your own exposure to these structural vulnerabilities. Consider what percentage of your wealth exists purely as entries in institutional databases versus tangible assets you physically control. This is not about panic or extreme measures. It's about the risk management that institutions themselves practice while advising clients toward the opposite approach. The failure of globalization isn't the end of prosperity. It's the end of a specific arrangement, one built on just-in-time supply chains, endless debt expansion, and the assumption that efficiency always trumps resilience. What replaces it will reward different strategies than those that worked over the past 30 years. The data suggests we're in the early stages of a fundamental revaluation, where the gap between paper claims and physical reality closes, often violently and without warning. Central banks are positioned. Institutional wealth is rotating. The World Economic Forum has acknowledged the structural limits of the system they championed. The arithmetic of debt, inflation, and currency debasement points in a single direction. The architecture of global finance is transforming. The only question is whether you see it clearly enough to respond, or whether you'll realize what happened only in retrospect, when the transfer is complete. Money has always been a story we agree to believe. The current story is ending. The next one is being written in central bank vaults, in delivery warehouses, in the quiet accumulation of assets that have outlasted every empire and every monetary experiment in human history. That's not pessimism, that's pattern recognition. And patterns, unlike promises, don't require faith.